This class is about accounting. It's an introduction to accounting, and it'll take us through some of the fundamental issues in accounting. Certainly the issues that will be encountered when first approaching the subject of accounting. So, first of all, a good accounting function is essential in the management of any business. It's imperative that management have access to good information about the business, about costs, about stocks, and about the functioning of the business. It's also vital that the management are able to control its own money, control its accounts, its bank account for example, to ensure that payments are met timely, that obligations are met, and that receipts are accurately recorded and expenditures are accurately recorded. So it's essential that not just the cash in the bank, but all resources are optimized, are accounted for, and their value recorded so that their return can be easily worked out. The purpose of accounting is to allow the business to keep track of their money. So it's to keep track of not just the final figure in the bank, the profitability of the business, that sum of money, but it's to keep track of all the payments, to keep track of all the receipts, to keep track of the asset values in the business, the value of stock, the value of capital. It's to accurately record these figures so that management can make, as I said, informed decisions, and also that investors will have a true and fair picture of the performance of the business. Accounting is all about recording, preparing and interpreting business transactions. Interpreting being putting the figures together in a standard way, and also helping management to understand the performance of the business. Perhaps we should make a distinction there immediately. Perhaps it helps the owners make a decision, because the owners will gauge the performance of management according to the accounts. The information is made available to people who need it, such as managers or owners, and who then make decisions to improve the performance of the business. That's the idea, the whole idea of accountancy. That's the purpose of accountancy. However, management accounting is used to monitor, plan and control the activities of a business. There are two types of accountancy we can discuss. One is management accounting, which is internal to the business, which is used to monitor, plan and control the activities of a business. And the second type is financial accounting, which is to do with presenting a true and fair view of the business to the outside world, to the government for tax purposes, and to investors who may wish to invest in the business. Management accounting is used. It allows the business to understand how the profits have been made. Management accounting, in monitoring and planning and controlling the activities of the business, in looking at the figures that underline the whole internal process of the business, it enables management to figure out where profits are being made, where are the high profit centers within the business, and also to ensure that they have enough cash to pay the employees' wages and all of the other essential payments, for example, services, electricity, gas, transport, and so on. And having some knowledge of the profitability of the business means that the the owners can then set dividend payments to the shareholders. And it's also possible out of the profits to expand the business or to reorganize the business or improve efficiency by improving technology within the business. So having a picture of how the business runs, how it runs internally, how production is organized, stocks, labor, capital, which is the function of management accountancy. How that works is essential in providing a picture for the management which indicates where there are efficiencies and inefficiencies. So better decision making can be made in the light of the information provided by management accounting. Financial accounting is the preparation of the monetary side of the business, if you like. It's the side of the business that we normally associate with accountancy. The balance sheet, profit and loss, break even, cash flow. But both functions are essential. One is to help internal management and the other is to provide a picture on the outside. So let's look at financial and management accounting in a little more detail. So we have the accounting function. Let's just take it generically. That is the accounting function. And then we have financial accounting. Well, financial accounting will be concerned with issues such as cash flow statement and the balance sheet, and also the profit and loss account and income statement. So financial accounting goes into three areas. The financial performance of a business and targeted at external users, for example, shareholders, lenders, suppliers, customers, and the government. Shareholders is highlighted there because shareholders are, of course, particularly important. The reason why they're in the business in the first place is to get a return on their investment, presumably. The second type of accountancy is, as we were talking about earlier, is management accountancy. This looks at costs and looks at how costs are controlled, how costs arise within the business, looks at all aspects of costing. And it takes the information from the cost figures, costs on raw materials, stores, costs of labour, costs of equipment, transport, costing. And it analyses those costs and this enables management to make decisions based on facts from inside the organisation. Management accounting, well, it's intended for internal use of a business in order to make the right decisions. So it's internal. Now let's look at cost accounting, management accounting. Cost accounting includes costing as a basis for pricing and stock valuation. It looks at planning, control and performance in terms of future costs and how to monitor them using budgeting and standard costing methods. Now we'll have to look at what we mean here by budgeting and standard costing methods in other videos, but essentially what the cost approach is to do is to set up budgets. When the business know what its likely sources of revenue for working capital is, then the accountants may set up budgets and attempt to stay within the budget. Only spend what is in the budget. So there will be several budgets. A budget for production, a budget for the stores, a budget for personnel, a budget for and so on. And try to stay within the budgets. And if they are successful and stay within the budgets, they know there is a good chance that the business will be profitable, providing sales and revenues flowing inwards hold up as anticipated also. Decision making includes, well, short-term decision making, so looking at, say, a break-even analysis, and long-term decision, strategic management, capital budgeting, and long-term finance. So decision making is in two parts, short-term and long-term. Short-term is to try to work with what there is, to optimize what there is, and to make sure that they know where the break-even is and to achieve output so as to generate profits above the break-even point. Long-term decisions, well, that's into the planning phase. That involves strategic management, capital budgeting, and long-term finance. But that really is long-term stuff and looking deeply into the future. Let's look at costs. Cost is the amount of resources, usually measured in monetary terms, sacrificed to achieve a particular objective. Now, in terms of economics, this is sometimes known as an opportunity cost, because if the money is spent on, let's say, raw materials, perhaps that money could have been spent better someplace else. Was it necessary to hold that level of raw material? Or could the money have been moved to an alternative which would generate a higher rate of return? So there's a balancing act in play. It's not just a question of stocking the stores. It's stocking the stores to the right level. Too little and production will stop. Too much and it's wasteful, because the excess could have been invested elsewhere. As I said, it's what economists call opportunity cost. These objectives may be to make a particular product or to perform a certain service. So the costs are incurred with an objective in mind, to make a particular product or provide a certain service. They're not just incurred for the fun of it. The aim of a business to make a product or service is to attract customer attention, such as the public or other businesses. So we've got a link with the market. The owners, the managers, must consider that the customers want the product. If they want the product, then they must make the product. Making the product incurs a cost. But there is a linkage all the way. Sales generate the revenues for the business. So sales are critically important, and producing the right product is important. So controlling costs will make the product more profitable. If the selling price is fixed in the market or a certain price can be achieved, then by controlling the costs or reducing the costs means a greater margin is achieved. And that's the function of the management accountants. So by controlling costs, the business may increase profits. Now, the classification of costs. Well, the main cost in a business include material costs, the cost of raw materials and storage, the cost of having materials brought to the organization, which is known as carriage cost. So there's a major element of cost. Now, of course, it depends on the business. It depends on which business we're talking about. Some businesses may not have a big stock of raw materials. And in a service-based economy, a lot of this would not perhaps apply to all businesses. A firm of accountants, for example, or of solicitors, they will not have a big stock of raw materials. They will have computers and office space and so on, but they won't have a big storeroom with inventory. The chances are they'll have some stationery perhaps, and that's it. So it depends on the nature of the business. For traditional manufacturing business, material costs can be significant, and that's one type of cost. Labour costs, these are normally in the form of wages and salaries, and there are also other related labour costs, insurance on the workers, and then there will be health and safety issues, and there are all sorts of other costs involved in employing people. So that's the second type of cost. The first is the material cost, the second is labour costs. The final type would be expenses and overheads. These are really external costs. There are costs such as rent, business rates, electricity, gas, postage, telephones, and similar items which will be documented by invoices from suppliers. It's a type of expense cost. Now I'm sure, depending on the nature of the business, that additional categories of costs may be identified. But these are certainly three important areas of costs. If additional ones are found within certain, perhaps new businesses, or if some of these do not apply within the new businesses, so be it. The point is, accountants will come up with classifications which are appropriate to the business they are considering. So that really takes us through the differences between financial and management accounting, and gives us a very brief overview of why accountancy is important. And that also concludes this video. So thank you for watching.